Should you invest in Berkshire Hathaway instead of an S&P 500 index fund? If you don't know what Berkshire Hathaway is, that's okay. It's Warren Buffett's company. It is a conglomerate. Warren Buffett, the fifth, I think, wealthiest man alive. And one share of Berkshire Hathaway is $700,000. Don't worry, they have Class B shares too that are $466. Comparatively, way cheaper. And in the last 10 years, Berkshire Hathaway stock is up 218%. That's outperforming an S&P 500 index fund, which is up around 190%. Now, an S&P 500 index fund invests in 500 large cap companies across all 11 sectors. These are all of the companies that Berkshire Hathaway owns outright. Like, they own these companies. You might recognize some of them, like Geico up here. Let's see, Fruit of the Loom right there, Duracell Batteries, Clayton Homes. They own Dairy Queen, but they are also in a lot of different sectors: insurance, utilities and energy, service and retail, and manufacturing. And these are a list of companies that Berkshire Hathaway partially owns. You can see a lot that you do recognize here, including Verizon, Chevron, Apple, Pilot, Kraft Heinz, Coca-Cola. Got some banking stuff, American Express, BNY Mellon. But there are some key differences between Berkshire Hathaway and an S&P 500. An S&P 500 index fund is what you would call passively managed. There's no one in the fund going, like Kathy Wood with the ARK fund as an example. She picks what goes in her fund. The S&P 500 ETF just tracks what's in the S&P 500. It's a pretty easy job. What's in the S&P 500? Okay, we'll buy all of those and they'll all go in our index fund. Whereas Berkshire Hathaway is actively managed, and it's not an ETF, but he's actively managing the portfolio. So with Berkshire Hathaway, there's no expense ratio, there's no fee. There is a fee with ETFs. Don't worry, you're not billed, but there is a fee with those. They're really, really small. I mean, next to nothing. So I wouldn't really worry too much about, I don't want the fee, so I'll get with Berkshire Hathaway. Just so you understand that they're different. Warren Buffett is picking what they own, what stock market's open, what they own, what they sell, blah, blah, blah. The S&P 500 just tracks the index. And this is the breakdown of sectors that you get in an S&P 500 index fund. Yes, it is heavily invested in technology, and then everything else gets smaller and smaller, but they still give you broad market exposure to all of these sectors. Just as a reminder, with Berkshire Hathaway, you're only in insurance, utilities and energy, service and retail, and manufacturing, so less diverse. Berkshire Hathaway, unlike an S&P 500 index fund, does not pay a dividend. They use their money to make new investments, make acquisitions, or do stock buybacks. All this means is that they can have a little bit more growth, potentially. Instead of passing those profits on in the form of a dividend, they're reinvesting and growing. It's also important to note that Berkshire Hathaway, or Buffett, goes really hard into the investments that he likes the most, which can mean over time that they are disproportionately holding more shares of certain companies, which puts them a little bit more at risk. You'll notice lately that he's been cutting back on the positions in Apple and Bank of America because they got disproportionately too large when in comparison to everything else. And that's not a sound strategy, even if those stocks could continue to do well. Question for you as an investor is, do you want the S&P 500 that has broad market diversity, giving you exposure to over 500 companies across all 11 sectors and pays a dividend? Or do you trust Warren Buffett, who is 94 years old? Just remember that. He's 94. The guy's not going to live forever. In some cases, it might not be an either or. It could be both. You could have the S&P 500 and a couple shares in Berkshire Hathaway if you were so inclined. All right, make sure you smash that follow. Thanks for watching. See you later.